This is the story of how genius goes bankrupt. In 1998, the smartest fund on Wall Street loses $4.6 billion in 4 months. 2 of the people running it had just won the Nobel Prize. It didn't save them, because the market does not care how smart you are. Or espresso. Let's talk about long-term capital management. 1994, John Merriweather, legendary bond trader from Salomon Brothers, starts a hedge fund. He doesn't hire traders, he hires professors. Among them, Myron Scholes and Robert Merton, the men behind the formula that prices almost every option on Earth. In 1997, they win the Nobel Prize. This fund has the highest IQ per square meter in finance. Their strategy? Convergence trades. Find 2 nearly identical bonds trading at slightly different prices. Buy the cheap one, short the expensive one. Wait for the gap to close. Free money. Almost. One problem, the gaps are tiny. Fractions of a percent. To turn pennies into billions, you need size. And size, in finance, is spelled L-E-V-E-R-A-G-E-R-A-G. LTCM borrowed roughly $25 for every one of its own. About $5 billion in capital, controlling over $125 billion in positions, plus derivatives with a notional value above $1 trillion. In 1998 money, and it worked. 43% return in 1995, a 41% in 96. Banks begged to lend them more. Everyone wanted in. The professors had solved markets, right? Here's the thing about models built on historical data. History is what happened, not what can happen. August 17, 1998, Russia defaults on its own domestic debt. Nuclear powers don't default, said the models. It happened anyway. Global panic. Investors dump everything risky and stampede into US treasuries. Every gap LTCM bet would close rips wide open instead. All of them, at once. Their models said these trades were uncorrelated, spread across the whole planet. But in a panic, correlations go to 1. There was only ever one trade, betting that calm would continue. With 25 times leverage, a 4% move against you erases your capital. LTCM lost $1.9 billion in August alone. By late September, $4.6 billion gone. Over 90% of the fund. And because half of Wall Street had lent them money, the fund was too entangled to fail. The New York Fed summoned 14 banks into one room. They put up $3.65 billion to take over the corpse. No taxpayer money, but a bailout in every way that matters. Decades earlier, the economist John Maynard Keynes supposedly put it best: the market can stay irrational longer than you can stay solvent. LTCM was right about most of its trades. Eventually, they just weren't alive long enough to collect. So what does the capybara take from this? 3 things. 1. Leverage doesn't just multiply gains, it multiplies the speed at which you can be wrong. 2. Diversification is a fair weather friend. In a crisis, everything falls together. 3. Being smart is not a risk model. 2 Nobel winners weren't enough. The market doesn't care about your credentials, your formulas, or your feelings. It only cares whether you survive long enough to be right. Stay solvent. Oil please. Stay calm. If you learn something, subscribe. Cap covers one brutal market truth at a time. Next up, why 90% of day traders lose money and why your broker loves it. See you there. And no, this is not financial advice. Cap is a capybara.